Okay, welcome everyone. It's time for a new Patreon exclusive. This one's going to be a new series that I'm starting, and I believe it's going to be 4 parts. So this is like the start of a big series. I'm calling it The Fundamentals of Investing. It could also be titled The Fundamentals of Wealth Creation, because I believe investing is synonymous with generating wealth. But investing is simple and complex at the same time. And in this series, what I want to do is I basically want to go through all aspects of investing, from the principles of it to the specifics of what this specific thing is in a financial spreadsheet. So we're going to be having discussions on very broad things and very specific things as well. So we're going to cover a lot of ground here. The scope of this series is very big. For example, again, I'm planning on splitting this up into 4 different parts. And part 1 is going to be broad concepts, going over things like, capitalism, getting ahead in our society, tips of things that I've noticed that get people further ahead in the workforce, in their careers, higher salaries, that type of thing. I'm also going to be discussing things like savings, how to save money, how important saving money is. We have differences in things like systematic risk and specific risk, in stocks versus real estate, in all these different categories of creating wealth and what I personally think are the best ways to do it. We have part 2. Part 2 is going to be specific to going over the financials of a company. A lot of people don't know the difference between gross margins and operating margins. They couldn't tell you the difference between that. And it's difficult to understand the financials of a company if you don't have a vocabulary and a basic understanding of the financials. Luckily, they're not that difficult. You've been told that they're difficult and that it's finances and it's very difficult. It's not. And I'm going to go through it in part 2. We're going to walk through the financial statements. We're going to go through examples of it. We're going to define and clearly give definitions to terms. And I think it'll be a very fun episode to go through. So we have part 2 there as well. Then part 3 is going to be valuation. When you understand a company, you understand the business, you understand the financials of it, you want to be able to know when a decent time is to buy it. So that's going to be the valuation discussion. We'll be going over different things like what the whole goal of valuation is, how it can fit into your investing process, and different forms of valuation, like what a discounted cash flow analysis is. And then finally, in part 4, is a part that doesn't get discussed enough, which is after understanding all of this stuff, how do you actually build a portfolio? How do you construct a portfolio of individual stocks that you've found? Or how do you pick a right ETF if you want to go the route of investing in ETFs? I'll give my input on what I think the best portfolios are, both with ETFs and with individual stocks, or with a hybrid of both. So again, we're going to be going through these 4 different parts, and this isn't going to be like super specifically organized, so we're going to be jumping around a little bit. But in this part today, we're going to be going through the broad concepts. These are just different points that I want to hit on that I think are important. And overall, the goal of this, what I want to do here is, I realize I'm not an expert, and I don't feel like I know everything or have everything figured out, but I do feel like I have enough experience now in life, and I've had a decent amount of success through various things that I've done, that at least I've learned something over the past 15 years. I've learned some things that have worked really well and things that haven't worked as well. And so having a history doing software development and working in different companies has given me an interesting perspective. So before we go into part 1, broad concepts, I want to just do a quick history of my experience so you can see where I'm coming from. Because a lot of this advice, in fact, all of it, it's not universal truths and things that I know, that is true everywhere. This is my experience. This is from my perspective. So I'm giving you what Joe thinks, what Joseph Carlson thinks is the best thing to do. But as the saying goes, and I don't like this saying, but there's more than one way to skin a cat, that type of thing. As the saying goes, there's more than one way to become wealthy. The way that I outline here is my preferred way, what I think works really well, predictably well. So this is all from my perspective. If other people have different perspectives, if other people have different backgrounds, if they have different experiences, they likely have a different way of looking at things, and that's okay too. So what you're getting here is my perspective. Take it for whatever it's worth, but this is my thoughts on generating wealth. Now, in terms of my background, you can go back to the schooling, that type of thing. I did this program in high school where you could kind of get a little bit ahead I got my associate's degree in science as I graduated high school. From there, I went into a lot of different things. I jumped around in college trying to figure out what I wanted to do. So I went into healthcare and switched out of that. I went into law and switched out of that. I went into a lot of different things. And then I landed on a computer type of degree because eventually I realized that I'm good with computers. I'm good at figuring things out on computers. So I did a web and application development program. That got me into different jobs in the workforce with a lot of different startup companies. Over time, I grew my experience as a coder and developer and overall kind of a software developer to where I worked on a lot of different things. I had a huge variety of experiences. So I could do things in the database, and I could figure out an SQL database and, linking things together and making inputs work and pulling the data that I wanted, all the way up to the front end where I'm doing different styling and different things with CSS and everything in between. So that's called full stack engineering, is when you can do all the layers of the stack. And that's what my job was. And it wasn't because I was particularly good at any of that, but it was because the companies that I worked for were startups. They weren't companies that had huge development departments where everybody was segmented to little aspects. The only developers there were the ones that had to figure out everything. So my job had many roles in many cases. As I got a little bit better through working in development, I got into positions where I would work between kind of the transition of where the business side of things meets the engineering side of things, meets the coding side. So for example, in one of the jobs that I worked at the longest, it was a sales organization, and I worked directly with the VP of sales. So he had a lot of people that would go and knock doors and do door-to-door sales. I worked with him to solve his needs and what he wanted for his teams. He'd say, we need these reports, we need this system, we need to be able to have this map when we knock on people's doors so we don't knock the same door twice. We need to have, all these type of things integrated into this application. I'd have to take his feedback and integrate it back into the software. And during these discussions, I got to see both sides of things. It was like being in the highway of business and engineering. So my background is working with companies where I've been in the discussions of the business side, of the sales and meeting quotas and, incentive structures and contracts for different people that we're bringing on in the company. And then I've also got to see the engineering side. I get to see what goes on in the engineering side and the development side of building out applications, hiring different talented people to work with. And that's been my experience. So as you can see, when I do YouTube, you can see that I've kind of used both of those things throughout YouTube. I mostly invest in technology companies, ones that I feel like I can understand. Those are typically software companies that I have some experience in. And I also, get some exposure to the business side, working in that as well. And it's also aided in some other things like Qualtrim. Having that experience in software development, I've made a lot of connections over time periods. I've known really good developers and not such good developers. And so I have a good idea of who to work with and not. And that's why Qualtrim is built really, really well. It's built enterprise application standards. So, the experience that I've had working in the private workforce has allowed me, I think, to have certain advantages in YouTube. And part of that is the development background, the engineering background, and kind of business background. Now, that's my experience. Again, that's the perspective I come from. So I realize what I say isn't fact, and it's not the way that may work for everyone. If someone has a background where all of their wealth has been made through real estate, then they're probably going to be a little bit more biased towards real estate, right? It depends on your background. So what you're getting here, again, to emphasize, is Joseph Carlson's background. This is my feedback. So these are the type of things that I've learned that I think are what I'd want to tell myself 10 years ago. If we go back to when I was 20 years old, so 13 years ago, this is the type of stuff I would want to tell myself. This is the type of stuff I'd be saying, look, listen, future self, or, past self, this is what you need to do. So let's go ahead and just go over some of the basics here. Now, the first thing is that the earlier you start with investing, the better. This is something that everyone should know, but where people get really in trouble with investing is simply when they run out of time. It's a big game of time. The most unfortunate circumstance is when people are in their late 50s and 60s and they haven't invested. that puts them in a terrible situation where hopefully they at least own a home or some assets that they've paid off. Because if they don't have any investments, they don't have any pension, and then you're getting into your late 50s and 60s, you don't have a lot of time for things to compound. Compounding works with time. And part of the reason that Warren Buffett is so incredibly rich is not just because of his compounded growth rate, but because of the amount of time he invested. He invested longer than a lot of people. And the majority of his wealth, over 95% of it, was made after he turned 60. So compounding works with time. And the important thing I'd stress here is to start investing as early as possible. Start sharing the message of investing to people earlier as you can. The earlier you get started, even when you're a teenager, I think that's best. Because if you have the principles of investing early on, you're going to have so much more time to compound, where you'll have so much wealth and freedom when you're older. And it may, be attractive to just want to live in the moment when you're in your 20s. I realize that's kind of the attitude a lot of people have, but a few sacrifices in your 20s could make for a great deal of leisure and comfort in your 40s and 50s. So I think it's a very good trade-off to make, to start investing early on. Investing is for everyone, every single person. There's no IQ test. There's no math test. You could have failed your SATs. You could have, whatever test you have. You don't have to be a good test taker. You don't have to be smart to invest. You really don't. I think a lot of investing comes down more to personality traits than smarts. There's a lot of doctors that are very bright people, very smart, that are poor investors because they don't have the right temperament for it. And many times they're focused on other things, so they don't have the attention span for it either. So investing is for everyone, men and women. It doesn't matter what you are, who you are, doesn't matter what you look like. Ugly, attractive, tall, short, doesn't matter what skin color you are. It is for everyone. That is a message that needs to be shared as well. One of my favorite parts of investing is that the bar to entry is so low that everybody can get in it and everybody can benefit from it. And this is a message that desperately needs to be shared. There's a lot of people right now that feel like everyone's working against them. They feel like they're part of this big enterprise cog where they go to work, they work their 8 to 5, and they can't get away from it. It's just they're part of the system, and then there's rich, ominous people in the background working against them, extracting labor out of them, right? And they're kind of victims of the system. That's the message young people are being told, that they're victims of a system right now. In reality, we are in a system right now where there is more opportunity for wealth creation and leisure and comfort than any other time period throughout history. At our fingertips, we have apps like M1 Finance, Robinhood, Schwab, Fidelity, where we can create an account, spin up a brokerage, and start buying stock interest in the most attractive businesses in the world today that will compound and work day in and out for us, day in and out for us. The message that young people need to hear today is that there is incredible opportunity, that investing is a path to grow wealth and leisure and comfort, that we can own part of America and the interest in America. This is the type of message that a lot of great investors have tried to share because it's one that's very apparent. In the system right now, and capitalism, I think, is a great system, but it's not without flaw. No system is without flaw, but capitalism offers a lot of great opportunities for people. And the more you learn about investing, the more you realize, wow, I'm in a system right now where every great company's for sale at my fingertips, and I can start to transfer my stored value, my savings, and my work to ownership of great companies. And the more that I do that over time, the more that I work, I earn money, I save some of it, and I buy interests in businesses, the wealthier I become. We need to understand, I think, and again, this is especially young people, but it applies to everybody of every age. I say young people because, again, it's so important to get started when we're younger, 20s, 30s. I think that's the time really to get started with this. Equity is the way that people become wealthy. It just is. This is what I've been around wealthy people. I've been around poor people. The difference is people that are wealthy continually buy equity in companies, businesses. They own interest in businesses. There's a couple ways to become wealthy without owning equity. You either need to be as good at golf as Scotty Scheffler and, Tiger Woods. So you need to be a pro athlete. Maybe you're like LeBron James or Steph Curry in the NBA. Your odds of doing that are they're tiny. A fraction of a society will do that. So pro athletes, one way to become wealthy. Then there's the other chance you can become a movie star. That's another way to become wealthy. These ways are, I think, rare, and they're not dependable to any degree. They're not something you can count on. There's a tiny fraction of society that will become wealthy that way. The other majority of us, the people that will become wealthy in different ways and reliable and predictable ways, is by buying equity in businesses. Businesses are incredibly powerful. They're wealth generation machines. A business exists to make money. That's its only purpose, is to make shareholders a return. The more interest you can buy in quality businesses, the more you have of these economic machines that generate wealth every single day. So when you look at people that are wealthy, what do they own? Well, some of them, again, they're doctors and lawyers and they have high incomes. But even then, doctors and lawyers don't become wealthy just by their income. They become wealthy by transferring their income to equity in businesses. It all comes down to equity in businesses. When you see a wealthy doctor, it's not one that just has a high income. It's one that has a high income that started buying equity by buying real estate. They bought their practice that they practice in. A dentist might buy the place that they run their practice out of, and then they start leasing it to different dentists when they're starting. Then they go and they buy different real estate that's under development in different cities. A lot of professionals like real estate, but there's other ways to become wealthy that I think are even more dependable, which is stocks. The majority of millionaires in the US are millionaires because of stocks, because of the US economy, and because of owning equity in the US economy, and especially the top quintile of top performing businesses. That is the S&P 500. People become wealthy because of their 401k contributions. That is owning equity in companies. Now, a lot of people don't understand that. The 401k is just kind of like a secondary thought, but I don't think that's enough. I think people should match their 401k, but also put huge effort, especially early on, into buying attractive quality businesses as fast and rapid as possible at a young age as possible. The returns on that and the compounding and the time make an immense change in people's lives later on. So to summarize, investing is for everyone. Doesn't matter what your IQ is. You can still be good at investing if you're smart, if you're slow, it doesn't matter. Man, woman, doesn't matter. Investing can be accomplished by everyone. You don't even have to have a great job or high salary. Investing is for everyone. You can start investing as long as you can start saving any money. So unless you're literally dirt poor, living on the streets, you can start investing. Capitalism is the system you have. So whether you complain about it or whatever you use it is up to you. But I'm of the attitude of not trying to complain about the world that I have, but rather than looking and observing the world and making the best of it. So use the cards you're dealt. Use the hand you're dealt. We live in a capitalist system. It rewards people that work hard, that offer value to other people. And capitalist system really rewards equity in businesses, which are wealth creation machines. A business only exists to make money for the shareholders. That's its sole purpose. And that increases the enjoyment out of everyone's life in the process. So, I would avoid getting into the attitude of resenting capitalism, resenting wealth and that type of thing. I think that leads down a bad path. Wealth is a great thing. It elevates people's lives. Everybody should aspire to make their own family wealthier and more comfortable, as well as other people's. Now, if we want to get into a couple things here, in terms of generating wealth and investing, one thing that I want to emphasize is the difference between real estate and stocks. This is a big debate, and I don't want to go over all the intricate details of it, but I'll just say this. A lot of people I found understand real estate more because it's more relatable to the human mind. You have a physical property there. If people rent it out, you get a paycheck. It's really not that different from stocks. Stocks are basically a name that sounds a little silly, but it's just a name for a business. The business could be a real estate company where they rent out and give you money. right? That's like Vici. It's just a real estate company. But stocks can also be different businesses that have even better business models than real estate. I think that stocks are overall a better route for most people because you remove a lot of specific risk. With real estate, you have all of your risk in one specific place. Stocks remove a lot of the upfront costs, meaning you don't have to have a 20% down payment. With the stock, you can go in and buy $500 worth of shares of a company. You don't have to have $50,000 to put down. So stocks have a lower bar of entry to get into. I also believe when looking at real estate and stocks, with real estate, you have way more leverage, and leverage means risk. You don't hear anyone going bankrupt with stocks, but you do hear about people, in some cases, going bankrupt with real estate because they take on too much leverage. And then overall, the biggest, I think, advantage of stocks is that with real estate, in most cases, you're kind of locked into buying properties around you. You might buy a rental in your city, and you might try to manage it. But with stocks, you have available to you a market of the best companies in the world, world-class companies. And it's a open playing field. Everyone has access to them. For example, when I look at the stock market, there is no other place on planet Earth that you can find access to buy better businesses. There's no alt investment vehicle that the rich and wealthy have. It's the stock market. That's where it's at. That's where the best companies in the world are at. You're not going to find companies better than MasterCard and Visa, S&P Global, Moody's, Amazon. You're just not going to find better companies nowhere else on earth. So the stock market gives you the advantage of having liquid access to the best companies on planet Earth. And you can buy them and wait to buy them at attractive valuations. There is no wealth creation vehicle like it. The public equity market, the stock market, is the best wealth creation vehicle in the world ever devised by humankind. And we have access to it on our cell phones. What a time to be alive. It is the best time to be alive for wealth creation. Now, if we kind of transition here, all of this is good. And I want to get into just one more aspect of this that I think is the most important aspect of this. But if we have the right attitude, let's say that we're starting off, we want to get ahead in life. We want to take advantage of capitalism. We want to start investing and put our money to work. Everything comes down to starting early, investing frequently, and buying attractive assets. And all of this comes from savings. Savings, savings, savings. That is the whole fundamental. That's the whole foundation of investing, is first saving money. So if you really want to get ahead in life, you are not going to if you don't save money first. And by saving money, I mean you don't go to work, earn a paycheck, and then spend the paycheck. That means you're not saving money. Don't go to work and work an 8 to 5 and then come home and spend your paycheck. If you do that, you're stuck in this endless cycle of working forever. You're never going to get out of it if you do that. You have to have some margin in between. You have to find areas to cut on your budget or to give a little bit of margin so you have a savings every single paycheck. You have to. It doesn't matter if you're making $60,000 a year, 50, 30, 20, you have to have some of it. If you're making a very low income, the best thing you can do is try to up your income a little bit. But if you're making a decent income, if you're making $70,000, $80,000 a year, then that's where you really have to have some savings. You have to be putting away money every single month into savings because you can't invest if you don't have savings. Now, on this note, there's a part of this that I want to play. This is from Peter Lynch. He has a whole thing over learning to invest. I'm a huge fan of Peter Lynch. I think he's one of the best. He's one of the best of just general wealth creation. But in this audio, he shares a story of how important saving money is, and especially not tying yourself down to purchases that destroy your wealth creation opportunity. One of the most common purchases that destroy wealth for people is cars. And Peter Lynch talks about this in this segment. I don't have Audible on my computer, so I'm going to go ahead and just play this here off the mic.
On a regular basis and starting young, whether it's $50, $100, or $500 a month. Consider the following two cases: Joe Big Belly and Sally Cartwheel. Big Belly.
He comes up with these two fictional people, and one of them is Joe Big Belly. And I believe the other one was Sally Cartwheel. But this is the story of Joe Big Belly and Sally Cartwheel.
Gets a job as a clerk at Walmart. He's living at home and saving every last dollar so he can make the $2,000 down payment on a $20,000 Camaro with a racing scoop on the hood. He takes out a car loan for the remaining $18,000. His parents have to sign for the loan, but Big Belly is making the payments. It's a 6-year loan at 10% interest, so he sends $200 a month to the finance company. He cringes the first time he seals the envelope, kissing $200 goodbye, but he forgets all about it when he's driving around the Camaro and his friends are telling him what a cool car it is. A few months later, there are scratches on the door and stains on the carpet, and nobody is oohing and awing when the Camaro pulls into the parking lot. It's just another car by now, but Big Belly is stuck with the payments. At the end of 6 years, he's sick of the Camaro, which lost its cool a long time ago. He's finally paid off the car loan, which cost him an extra $10,800 in interest charges. So between the loan and the original purchase price, Big Belly has invested $30,800 in this car, not including taxes, insurance, gas, oil, and maintenance. At this point, the Camaro has more dents and more stains, and the engine sounds a bit rough. So what he's got to show for his $30,800 investment is a $6,000 clunker that he doesn't even like anymore. Sally Cartwheel also lives at home and works the Walmart checkout line a few feet away from Big Belly. But she didn't buy a cool car. She took the $2,000 she saved up and bought a used Ford Escort. Since Sally paid all cash, she didn't have car payments. So instead of sending $200 a month to the finance company, she invested $200 a month in a mutual fund for stocks. 6 years later, when Big Belly...
So see the difference here. Joe Big Belly bought, this Camaro or whatever it was, and he was very excited about it. But he made payments every single month in interest. When you buy the car, typically you get it on a loan, and then you have a payment stuck with it. And then he talks about how after the first couple of months, the excitement started to fade away. And that's what happens every time with these type of large purchases. It's a psychological thing we have. When we buy some item, the enjoyment we get out of that item is very temporary. People call it the honeymoon phase. Like when you're past that initial phase, you go through this period where the initial excitement's over, and then it kind of just levels out from there. So you have the phase in a car where you purchase the thing, you're super excited, it feels super new, and you're showing it off with all your friends, and then like 6 months later, it's just another car. Everyone's seen it, nobody's interested in it anymore, but you still have the payments. The car payments go on for another 5 years. And this is during Peter Lynch's time when he was making content like this. This is like 20 years ago. Now the car payments go for 7 years. So the problem's even way worse. And people are being talked into buying way more cars, way more car than they need, right? They're buying $50,000, $60,000, $70,000 vehicles. So this is a serious problem. People get into these vehicles, they spend too much money, they're making interest payments to the bank for, that are basically like mortgage payments for years and years and years. But then there's the alternative. This is what sacrifice looks like.
Was mailing out his last car payment. The value of Cartwheel's mutual fund had doubled. Between the doubling of the fund itself and the steady stream of $200 contributions to the fund, Cartwheel has a $22,000 asset. She also has the Escort, which got her back and forth okay, and the dents and the stains she never worried about, because she didn't think of her car as an investment. It was only transportation. As we leave this economic morality tale, Cartwheel has enough money to make a down payment on an apartment and move out of her parents' home, while Big Belly continues to mooch. He's asked her out on a date, but she's taken a fancy to the real estate agent who's showing her around.
So in this little tale, this fictional tale, you have the two people. One of them chose to drive a clunker, a piece of junk car that just got him to work and back, scratched up and dinged up and very old. The other one decided to buy a new vehicle and pay payments on it for 5 years. The difference is the one that bought the clunker had $20,000 saved up after 5 years, which then you get the snowball rolling. She has an extra $20,000, which she used to buy a down payment on a house before homes get really expensive. There is a time where $20,000 got you into a house. Then you have another asset that is an inflation hedge that takes away mortgage interest payment. You get into a house, you get into it at a low payment, and then you're locked in for 30 years at this low payment. So your wealth starts to compound, but it comes from saving. It comes from making sacrifices. This is something that I think is so detrimental that especially young people, you're convinced when you're in your early 20s that you're not going to be like attractive to girls or to other people or your friends. You're not going to be cool if you own a piece of crap car. It's just not the case. No one cares. I always drove I had a Honda Civic, and I thought it was cool. It had tinted windows, it was a nice Honda Civic, but it was a Honda Civic. It was just a pretty basic vehicle. It wasn't anything, extraordinary. It was a pretty cheap car, and I drove that for as long as I could. After that, I still didn't get expensive cars. Every vehicle I've purchased has been under $30,000, typically way under that price, because I buy them used. I buy them in not perfect condition. And I think that's been one of the biggest things that's allowed me to generate wealth over the past 10 years. It got me into my first home because I had savings for it. I was able to afford the down payment for my first home because I saved aggressively. I didn't buy expensive vehicles. Owning the first home appreciated $70,000 in value in 3 years, allowing me to get into my second home because of the equity in my first one. So the only reason that I'm in this house right now, a nice big home, is because 10 years ago, I didn't buy a car. Not buying the car allowed me to save for my first home. Buying that first home allowed the equity value of that home to compound as home prices went up. Allowing the equity value to compound increased my ownership of the home so I could sell it and use that for a big down payment, buying 40% of this home. So these decisions that you make today have dramatic snowball consequences later on. And I try to encourage everyone as much as possible. Early on is the most important time to make good decisions, to have good judgment, to not get into expensive ownership of vehicles, to not overpay for stuff like that. Do small things for enjoyment. Go out to restaurants, do things that are 40, 50 bucks. Don't do things where you're paying $500 a month. That is a huge tax on your wealth and has huge consequences. So cars are just one thing. There's certainly other places that you can overspend money, but the most important thing is to look at everything early on in terms of opportunity cost. Whenever you overpay for something or you pay for something expensive early on in life, it has huge implications later on. If you're going to college and you're taking on student loans, take the minimum that you can to get through your degree. Don't take student loans in bulk, not worrying about paying them off. And try to go into something that you have a high return on your education. In my case, I didn't take on student loans. I worked part-time through college to try to minimize that. So these type of decisions have huge consequences later. But overall, I think that's the summary for the broad concepts here. In summary, capitalism can serve you. So we can either have the attitude that a lot of young people have of resenting it and complaining about it and feeling like you're exploited, or using the hand you're dealt, getting ahead in this world, using it to get ahead in your work, using it to get ahead in life. We do that by increasing our income through work. So working hard to get raises and that type of thing, and then aggressively creating margin with our savings. That extra margin, instead of using it for lifestyle creep, which means ordering food and buying the $7 Starbucks and doing all those things that just eat away at your income, use it to invest aggressively. Investing aggressively, it'll start off small, but it will quickly build up to a snowball. That snowball will give you so much opportunity in the future. Down payments for houses gets you in a better situation. It makes you feel less stressed because you have savings and you have investments on the side. The compounding effect increases with time. So the more money you have to work with earlier, the far better situation you're going to be in. This economy will reward people who buy equity in businesses. So whether you're buying real estate, whether you're buying stocks, the more equity you can own in very quality companies and attractive assets, the more that's going to serve you over time. And on a note of compounding, almost always people underestimate compounding. They don't think it's as strong as it is. When you do any of those quizzes, like how much money would a penny be if it doubled every day for 30 days, people underestimate routinely how much it will be because our minds can't wrap around compounding really. Compounding over time has a huge effect. So you don't need to have wild returns and take wild bets. You just need to have attractive returns for a long period of time. And that means investing early, having some discipline, having some sacrifice, saving early, increasing our income, and investing as aggressively as possible in attractive return assets. That creates a very strong compounding component where you're almost guaranteed to have a certain degree of quality of life and wealth later on. So that's my first thought starting off. Again, this is all my thoughts on it. There's a lot more I could go into, but I don't want this to go too long. I want to get to part two. Part two goes into, now that we have savings, now that we're working hard, we're getting ahead in our careers, we want to understand companies. And a lot of people don't understand companies because they can't get their heads around the income statement, the cash flow statement, and the balance sheet, profitability ratios. So we're going to be going over all of that type of financial stuff. Don't be intimidated. It's not difficult. I promise you it's easy. So we're going to be going over all of it in part two.